Iron Condors are one of the most popular option income strategies in the market. They look safe, they look consistent, and many traders are told that they have a high probability of profit. But then one week changes everything. A sudden volatility expansion, a trend day, an earnings shock, or a major macro event, and then the Iron Condor that worked 10 times in a row suddenly gives back months of gains. In this video, we're going to break down exactly what Iron Condors are and why Iron Condors fail in certain market environments, and the hidden risks that most retail traders ignore, and how professional hedge fund traders decide when not to trade them. Hey, it's Frank Nagy. Welcome to my channel where we help financial entrepreneurs grow their business in the financial markets. If you're new here, subscribe to my channel and hit that like button. At the core, an Iron Condor is a short volatility strategy. You're selling premiums on both sides of the market, a short call spread and a short put spread below the price. The goal is simple. You want the market to stay inside a range until expiration. Time decay works in your favor. Implied volatility usually contracts. And statistically, many positions expire worthless. That's why Iron Condors can produce a high win rate. But there's a major problem. High probability does not mean low risk. In fact, Iron Condors contain what hedge fund professionals call negative convectivity. That means losses can accelerate quickly once price moves aggressively towards one side of the structure. The first environment where Iron Condors fail is during strong directional trends. Iron Condors perform best in balanced, rational markets. But when markets begin trading aggressively, delta exposure increases and gamma risk accelerates, and adjustment costs can rise rapidly. A slow grind higher can also be especially dangerous. Why? Because retail traders often keep rolling the challenge side higher while collecting smaller and smaller credits. Eventually, one momentum breakout can overwhelm the entire structure. And this happens frequently after, let's say, Federal Reserve announcements, CPI reports, employment data, geographical events, and liquidity-driven breakouts. But the market stops behaving statistically and starts repricing risk aggressively. That's when Iron Condors become vulnerable. Hiring experienced hedge fund consultant like Frank Nagy Financial Services will greatly reduce the burden of setting up your hedge fund or offshore broker-dealer. A good consultant will make the appropriate introductions with hedge fund administrators, brokers, auditors, attorneys, and prime brokers and banks that will help your hedge fund or broker-dealer grow. Another major reason why Iron Condors fail is entering during extremely low implied volatility environments. This is one of the most misunderstood risks in option trading. When implied volatility is low, option premiums shrink and risk-reward deteriorate, and retail traders are forced to sell strikes closer to the price just to collect enough premium. That creates a tighter margin for error. And at the same time, low volatility environments often precede volatility expansions. In other words, the market becomes most dangerous right when condors appear the safest. A sudden volatility spike can cause short strike to inflate rapidly. Even if the price remains inside the wings temporarily, Vega expansion alone can create a major unrealized losses. Experienced hedge fund traders monitor IV rank, realized volatility, event risk before placing condors on the trade. And next comes gamma risk, and this is where many 0DT and weekly Condor retail traders get wiped out. As expiration approaches, gamma increases dramatically. That means a small price movement creates disproportionate large delta changes. A position that looks stable can become highly directional within minutes. This is especially dangerous in indices options, high volume expiration days, and markets with algorithmic momentum flows. The closer expiration gets, the less room you have to adjust. Many retail traders believe short duration condors are safer because of faster theta decay. Faster theta comes with faster gamma, and hedge fund traders understand this trade-off. Retail traders often misunderstand this. Iron Condors also fall during event-driven markets, and after that event releases, the market rapidly reprices. Examples include Fed Reserve announcements, CPI reports, geopolitical headlines, and unexpected economic data. During those periods, historical probabilities become less reliable. The market is no longer trading inside normal distribution. It's trading around uncertainty, and uncertainty destroys short premium positions faster than most traders expect. Hedge fund traders do use iron condors, but usually far more selectively than retail traders. They focus heavily on volatility, liquidity conditions, macro events, realized implied volatility, and portfolio exposure. Many professionals avoid condors entirely during expanding volatility cycle breakouts, unstable macro conditions. They may shift focus on calendars, directional spreads, and define risk volatility structures. The key difference is this: hedge fund traders don't ask how much premium can I collect, they ask what environment favors this structure. The mindset changes everything. Iron condors are not bad strategies, but they are environment dependent strategies. Understanding which market conditions would apply to an iron condor and when to apply it will make all the difference in the world. Because in option trading, structure alone is never enough. Risk environment determines survival. Hey, if you'd like to learn more about how Frank Nagy Financial Services and how we can help you set up your hedge fund or offshore broker dealer, click on the links in the description box.